I'm not going to mince it. It's about inflation. Bring up the chart right now. Randy, I'm glad you're remote because you'd be in tears if you saw this chart. It's the inflation we're living. And the idea here, thank you, John Taylor of Stanford, is we need 2% inflation. Okay, well, there's 2% inflation. It's the green line. And the answer is the presidential moving average, four-quarter moving average, is elevated COVID and all the rest. Randy, do you on a first-order basis have a real conviction we can get back anywhere near 2% inflation?
Oh, I think we can. It's not going to happen in the next quarter. It's not going to happen by the end of the year. But I do think that within, let's say, a year to 18 months, we can be pretty close.
Okay, so when we talk about 2% inflation, the Fed focuses on core PCE, which backs out food and gas, not the headline inflation number. The new Fed chair, Kevin Warsh, prefers the Dallas Fed trimmed mean, which takes out the outliers. So kind of like a judge in figure skating, you throw out the top score and the bottom score. So my question is, Randy, for consumers, this can feel like a very narrow way of measuring inflation. You remove food, you remove gas, you remove the outliers at both ends. It leaves you something in the middle that doesn't reflect anyone's lived experience, and then making policy based on it. Is this something that can or should be fixed?
So I always joke that it's only an economist who could think about the consumer basket as excluding anything about eating. So you would starve to death, and anything about driving or keeping your house warm or cool. The reason for doing that is not because of lack of concern about people, but it's really looking for what is going to be the best metric for seeing where inflation is going, rather than looking at inflation in the rearview mirror, because we're, of course, always getting data from the past, not from, we want to figure out what's going on in the future. So the idea behind it is, starting in the 1970s, was to take out the high volatility sectors, things like food and energy, because that's a lot of noise. It's not necessarily telling you where things are going. Trim mean, in some sense, is a version of that, because if you think about what taking out food and energy is, you're just saying, well, we always want to trim out the volatile food and energy sectors because we think of those as outliers. The Dallas Fed approach is saying, well, we don't know from month to month what the extreme is going to be, so let's trim those out, because if something is moving a lot one month, it might be coming back the next month.
Randy, I want to cut to the chase. Brown University tuition since COVID has gone from $74,000. They're topping ticking it this year at $97,000. That's what our viewers in personal finance, retirement, that's what they feel. And the worry here is a sustained inflation where we don't get legitimate, real wage growth. Is that a risk for our savers, our personal finance in America, that we don't get legitimate wage growth?
No, that's a real risk, and that's really the key thing, and you really put your finger on it, because the key is how much are people making relative to how much things cost. So if your wages are going up at 10%, and inflation is 5%, you're feeling pretty good, because even though prices are higher, you still have really strong purchasing power. But if it's the opposite, that prices have gone up 10% and your wages have only gone 5%, you're pretty upset because you can barely put food on the table. So that's really the relevant thing, and that's what Kevin is focusing on, because he's saying, well, I'm very optimistic about what AI is going to do, increasing productivity and increasing real wages. Of course, that's a bet, but that's what he's focusing on.
We don't have time for this on Bloomberg Money, but I'm just going to say I was blown away by everything about the Warsh task forces, except Kroszner's not on there. Why is Randy Kroszner not on the task force? You know this. Let's go to it right now. Adam Posen and Peter Orszag. It may be my essay of the year, The Risk of Higher U.S. Inflation. Orszag and Posen push against Hatsias at Goldman Sachs. A tighter labor market reflecting the effects of the shift in immigration, monetary policy looser than commonly appreciated, and inflationary expectations. Inflation, they would suggest, Scarlet, is drifting higher.
Right. I mean, what it comes down to, Randy, is that a meaningful segment of the population, the hollowed out middle class, young people in particular, they've lost faith in the ability of the Fed to do anything on reducing inflation. They've gravitated to things like crypto or prediction markets as a solution. From their point of view, the system is broken, and they might as well bet on low probability, high impact outcomes. How problematic is this behavior for, the stability of the economy, the stability of the financial system?
And you also see it with meme stocks, too. It's another example of people taking high-risk bets, and maybe it'll pay off, but it's awfully risky. So I think there is a breakdown of trust, and I think that is a real problem. We saw that because inflation went up so high when the Fed was saying transitory, 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 as inflation kept spiraling higher and higher. And Kevin Warsh has made it really clear when asked about these sorts of things that I'm not getting into that game of saying what's transitory or not. What I'm going to do is try to get big picture trends in the economy. Where broadly is inflation going? What are the key drivers behind inflation? And what is the role of productivity growth? So that's what he's going to try to do to get, restore faith in the Fed rather than those short-term predictions that, although the Fed is probably the best predictor of anybody, they're still not very good.
Randy, your advice here. I think of Booth School in Chicago, Steve Levitt, Freakonomics, everything that Becker did. I mean, the heritage here of our system economics. Do you have a confidence that we will solve our retirement system, the next go-around of Social Security reform, and indeed retirement reform?
I think it'll never be fully solved. We've had patchworks that come every decade or so when we see that the Social Security Trust Fund is going to run out of resources. And the most recent report says it's coming pretty soon, 2030, 2032. And so it's not purely economics, it's really political economy. What will the politicians be willing to do? So one of the obvious fixes is to increase the retirement age. When this was first implemented by Roosevelt, people's expected lifetime was much, much shorter than it is today.
Yes.
And we've moved things up a little bit, but not nearly as much to reflect the much better health outcomes that people have.
Totally.
And so there are a whole variety of things that could be done to address that.